Imagine this. Every time you swipe your credit card, buy new shoes, pump gas, or even make a deposit in your bank, a single company profits. Not your local shop, not your bank, but a $10 trillion colossus quietly sitting behind the entire global economy. Sounds like a conspiracy? It isn't. It's called BlackRock, and what they control touches almost everything you do. But before you grab your tinfoil hat, let's clear one thing up. BlackRock isn't some shadowy villain hiding in the basement of capitalism. What they actually are, and the system they help shape, makes the story far more complicated and way more important. So, does BlackRock really own the world? Or have we just handed them the power to manage it? Let's pull back the curtain. Let's start with the basics. BlackRock is an asset manager. That means its business model is simple on the surface. It takes money from clients, invests it in financial markets, and charges a fee for doing that. BlackRock is not a traditional bank. It doesn't take your deposits and then lend them out like a local branch. It doesn't manufacture products or sell you sneakers. Instead, it sits in the middle of the system, between huge pools of money on one side and the companies, bonds, and assets that money goes into on the other. Most of the money BlackRock manages belongs to institutions, pension funds, insurance companies, university endowments, foundations, and big corporate retirement plans. But if you zoom in one layer deeper, most of that money ultimately comes from regular people, workers with 401(k)s, teachers with public pensions, families paying tuition, and anyone paying insurance premiums. So even if you've never heard of BlackRock until now, there is a decent chance that a piece of your paycheck is flowing through it. BlackRock's power rests on one invention from the 1970s that seemed harmless and even democratizing at the time: the index fund. Instead of trying to pick winning stocks one by one, an index fund buys every stock in a particular market index, like the S&P 500, in roughly the same proportions as the index itself. It's like deciding, I'm not going to bet on one horse in this race. I'm just going to bet on the entire race. The advantages sound great. Lower costs, because you don't need an expensive team of stock pickers making trades all day. Lower risk, because your money is spread across hundreds or thousands of companies. More predictable returns, since you're tracking the overall market rather than gambling on a few big bets. For investors, especially long-term ones like pension funds, this idea is incredibly attractive. For asset managers like BlackRock, it's even better because they can collect fees on massive pools of money without constantly paying for analysts to trade in and out of positions. Over time, index funds and similar products called ETFs, exchange-traded funds, exploded in popularity. The result: BlackRock and a few competitors quietly became owners of small slices of almost every large company you can think of. BlackRock loves to describe itself as a passive investor. What that means in practice is that instead of constantly buying and selling, it buys shares in a huge number of companies and then just holds them as long as they remain in the index. This passive label is more than a marketing term. It's also a legal shield. Because they are not actively trading to control specific companies, they argue that they should not be regulated like banks or activist hedge funds. But here's the paradox. When one firm holds stakes in thousands of corporations at once, across almost every sector, there is nothing truly passive about the influence that ownership gives them. Even if BlackRock's stake in a given company is only 3 to 10%, in modern corporate governance that can be enormous. Ownership is often fragmented, thousands of small investors, funds, and institutions. So a 5% stake can easily make you one of the largest shareholders in the room, often the biggest. Now imagine that not just in one company, but across airlines, tech giants, oil companies, retailers, pharmaceutical firms, and major banks. You start to see how a silent partner can have a very loud effect on how the entire economy behaves. Here's where it gets less abstract and more personal. When you invest in a retirement plan or your employer contributes to a pension, the money typically goes into a fund. That fund then hires an asset manager, like BlackRock, Vanguard, or State Street, to invest that money in stocks and bonds. But there's a hidden trade in that process: voting power. Shares don't only represent ownership, they come with votes on key corporate decisions. Who sits on the board? How much executives get paid? Whether to merge with another company? How aggressively to cut costs or pursue risky projects? Sometimes even whether to adopt environmental or labor policies. Once your pension fund sends your money to an asset manager, it usually passes the right to vote those shares along with it. So BlackRock ends up voting in board elections and on shareholder proposals using shares purchased with your money, even though you personally never get a say. Studies have found that large asset managers almost always vote with corporate management. Instead of challenging executives, they typically support the board's recommendations, even when those decisions might contribute to wage stagnation, risky strategies, or harmful practices that affect workers and communities. Why? Because from their perspective, their main source of profit is not squeezing out every last bit of performance from a single company. Their profit comes from fees based on total assets under management. The bigger the pile of money they oversee, the more they earn, regardless of which company beats another this quarter. That makes them cautious about upsetting corporate leaders who might be their clients on one side while being invested in them on the other. There used to be a myth, and for a while, a partial reality, that the stock market was a kind of mini-democracy for people with some savings. In the mid-20th century, a huge portion of corporate stock was held directly by households. Ordinary families could, in theory, vote their shares and shape the direction of companies they owned. Fast forward to today, and that picture has changed dramatically. A much smaller share of stock is held directly by households, and a huge chunk is owned indirectly through funds managed by big financial firms. Even among households that do hold stock, ownership is extremely unequal. The top 1% of Americans own a giant portion of all shares. The top 10% control the overwhelming majority. The bottom half of the population, meanwhile, owns almost no stock at all. So when corporate boards and executives say, "We're acting in the interests of our shareholders," they are mostly talking about a very small, very rich slice of society, plus a handful of gigantic institutions that vote on everyone's behalf. And because those institutions tend to vote in ways that favor higher profits, cost-cutting, and short-term gains, the system steadily channels more value toward investors and away from workers and consumers. The result is not a free market democracy, but something closer to a shareholder oligarchy, a world where a small group of asset managers and wealthy investors have outsized influence over how companies behave, even though they're not the ones doing the actual work. Economists have a term for what BlackRock and its peers have become: universal owners. Because they hold shares in such a large fraction of the market, they don't just bet on one company in a sector, they own a little piece of all the major players. Think about the sneaker and sportswear industry: Nike, Adidas, Under Armour, Lululemon, and others. If you, as an individual, invest in just one of them, you want your company to crush the competition, better products, lower prices, more market share. But if you're BlackRock and you own shares in all of them, your ideal outcome looks different. You don't want a brutal price war where everyone cuts prices and profits collapse. That might be good for consumers, but it's bad for portfolio returns. What you'd quietly prefer is stable, high prices and comfortable margins across the entire industry. And that's exactly the kind of logic universal ownership can encourage. The same pattern shows up in airlines, where a handful of big carriers dominate many routes. If the same large shareholders are behind multiple airlines, no one has much incentive to start a destructive price battle that would benefit passengers. In banking, in telecom, in many consumer industries, you see similar patterns: fewer players, more shared ownership, and prices that seem mysteriously sticky on the high side. Companies don't have to sit in a smoky back room and collude. They simply understand that their biggest shareholders win either way, as long as all of them do well together. That soft pressure can be enough to dull competition and keep prices elevated. All of this might sound abstract until you translate it into everyday life. When asset managers push companies to maximize shareholder value, one of the fastest ways to do that is by cutting costs, and the biggest cost for many businesses is labor. Freezing wages, replacing full-time jobs with contract work, fighting unions, outsourcing, and cutting benefits are all tools that can quickly improve profit margins. Those higher profits translate into better earnings per share, which help keep stock prices elevated, which in turn make big institutional shareholders happy. But for workers, this looks like wage stagnation. Productivity and corporate profits have climbed, but paychecks for many people have barely kept up with inflation. At the same time, basic expenses like housing, healthcare, and education have become more expensive. In a world dominated by universal owners, it often doesn't matter which company you work for. If nearly all of them are under pressure from the same set of large shareholders, they can all be nudged in the same direction. Cut labor costs, fend off competition, keep prices high enough to satisfy investors. So even if you don't know BlackRock exists, its incentives are woven into the workplace policies that shape your life. You might assume that if BlackRock wanted to influence a company, you'd see it in dramatic public showdowns, votes against management, fiery speeches at annual meetings, hostile campaigns. But that's not usually how it works. BlackRock and similar firms rely heavily on private engagements, closed-door meetings with executives and board members, where they can make their preferences known quietly. They have thousands of such meetings every year with companies across their portfolios. These conversations can touch on executive pay, climate risk, long-term strategy, and more. From BlackRock's perspective, this is a more constructive way to shape corporate behavior than embarrassing management in public votes. But from a democratic perspective, it means that crucial decisions about how these companies operate and how they affect the rest of us are influenced in rooms the public never sees, by people we never voted for. You might never hear BlackRock's name in a news story about a price hike, a factory closing, or a wage freeze. Yet their quiet preferences and incentives are often part of the background context that made those decisions more likely. BlackRock's influence doesn't stop at corporate boardrooms. It extends deep into governments and global institutions. Over the years, many former regulators, central bankers, and high-ranking government officials have gone to work for BlackRock. At the same time, some BlackRock executives have moved into official positions or advisory roles in public institutions. During major crises, such as the 2008 financial meltdown and later market disruptions, BlackRock has been hired to help governments and central banks analyze markets, manage portfolios of distressed assets, or design intervention strategies. Its CEO, Larry Fink, sits on influential international bodies and has had his name floated for top economic posts. When regulators debated whether firms like BlackRock should be treated as systemically important, essentially too big to fail and therefore subject to tighter oversight, BlackRock pushed back hard with lobbying and public relations campaigns. The message is subtle but powerful. BlackRock is not just another market participant. It's woven into the machinery that writes the rules of the game. That raises a tough question. If one of the biggest beneficiaries of the current system is also helping design and influence that system, how likely is it that the rules will change in ways that reduce its power? Now here's the truly mind-bending part. If you look at who owns shares of BlackRock, you'll find other giant asset managers. If you look at the top investors in those firms, you often find BlackRock again, plus many of the same financial giants. It's like a hall of mirrors. Asset managers own pieces of other asset managers. Banks own pieces of funds that own pieces of banks. Private equity firms buy up insurance companies that invest back into funds run by the same network. The financial sector, in many ways, has learned to recycle ownership within its own elite circle. This doesn't mean money literally never leaves the system. Investors still get returns, and people still receive pensions. But it does mean that control and influence are concentrated in a relatively small web of interconnected institutions that often hold each other's shares. When the same few firms own pieces of each other and of almost every major corporation, the idea of independent, competing owners starts to look like fiction. Let's be precise. No, BlackRock does not literally own everything. Most of the money it manages belongs to clients. It holds shares, not entire companies. It doesn't directly run your local grocery store or decide what your boss says in your performance review. But in modern capitalism, owning even a small fraction of a company across thousands of firms comes with serious power. Power to vote on directors and policies. Power to pressure management in private. Power to shape how entire industries think about risk, return, and responsibility. BlackRock doesn't need to give orders like a movie villain. Its influence works through ownership, incentives, and access. So the more accurate way to put it is this. BlackRock doesn't own the world, but it sits near the center of a structure that steers how the world's wealth is organized. And that structure is designed to keep profits flowing upward, often at the expense of everyone else. Some policymakers have started to notice the risks of this concentrated, passive power. There are ongoing discussions about whether giant asset managers that own big pieces of major banks should be regulated more like those banks themselves. Proposals include subjecting them to stricter oversight, more transparency, and tighter rules about how they can use their voting power. There are also debates around whether universal ownership should be limited in certain concentrated industries to prevent soft forms of anti-competitive behavior. Some experts suggest rules that would force large institutional investors to choose, either diversify broadly or focus on fewer companies, but not quietly own slices of competing firms that should be truly independent. However, pushing these reforms through is difficult. Asset managers have considerable political influence, strong lobbying operations, and a powerful argument. They claim to offer low-cost investing tools that help ordinary people save for retirement. Challenging that narrative and rewriting the rules takes time and a lot of political will. So what does all of this mean for you personally, beyond an interesting story about a giant financial company? It means that when your wages feel stuck while company profits hit record highs, your rent, groceries, flights, and basic services keep getting more expensive, your retirement savings are tied to markets that seem disconnected from real economic pain. You're looking at symptoms of a deeper structure. A structure where a small number of institutions sit at the crossroads of nearly all major economic decisions, pushing in a direction that systematically favors investors over workers and consumers. It also means that your own money, your pension, your retirement account, your premiums, may be helping to sustain a system that doesn't necessarily work in your broader interests. That's not your fault. The system was built that way. But understanding that connection is the first step toward questioning whether this is really the best we can do. BlackRock did not invent inequality, financialization, or corporate greed. What it did was perfect a business model that sits comfortably on top of all of those forces. If nothing changes, the current trajectory leads to more concentration, more wealth at the top, more influence for universal owners, and more pressure on companies to prioritize shareholders over everyone else. But it doesn't have to stay that way. People are already debating alternatives. Stronger regulation of large asset managers, giving workers and communities more direct say in corporate governance, reforming retirement systems so that they don't rely as heavily on concentrated financial giants, encouraging real competition instead of quiet coordination between universal owners. These ideas are complicated and politically contentious, but they all start from a simple premise. The people who create the wealth, through their work, their spending, and their communities, should have more of a say in where that wealth goes. Right now, that power is tilted heavily toward a small group of firms that most people never think about. Bringing them into the spotlight is not about blaming one company for everything wrong with the economy. It's about recognizing how deeply this model shapes our lives and deciding whether that's acceptable. If you watch this far, you now understand that BlackRock isn't just a name in financial news. It's a key node in a system where your money, your job, and your cost of living are all connected, often in ways that benefit a few and squeeze the rest. They don't own everything. But until we change the rules, they don't really have to.